Alright, welcome guys. So this is King Helps, and in this teaching I'm going to be going through introduction to forex trading, understanding the basics. So this video is going to be solely focused on the kind of foundations you need to build to understand what goes on in the forex market and how to operate in it, right? So these are the things we are going to be going over, right? So we're going to be going over what is forex, how forex trading works, what we trade in the forex market, understanding currency pairs, how to read the forex code, what is ask, bid and spread, what is a lot, trading with leverage, what is a pip, putting it all together. So finally, after going through all these basic concepts, we're going to try and put it all together in a practical example to see how you would operate if you were to open an order or something like that. So without further ado, let's get into it. So number one, what is forex, right? So it's the fundamental question here. What is forex? So forex is the global financial market that allow one to trade currencies. So let me give an analogy, right? So if you've ever traveled to another country, you usually had to find a currency booth at the airport and then exchange the money you have in your wallet into the currency of the country you are visiting. So let's say, for example, you are an American visiting Japan, right? What you're going to have to do is that you're going to have to sell your dollars to buy yen, right? And then when you're going back home, you stop by the exchange booth again to exchange that yen, the remaining yen that you have, to buy dollars. And then you notice that the exchange rates have changed, right? So let's say when you were going, you had to like, let's say spend $1 to get 176 yen, or let's just round it up and say to get 200 yen. And then when you're coming back, now then the exchange rate, let's say it's $1 to get 250 yen, right? So the exchange rates have changed. So when you hear forex or fx, because those are usually the terms going around social media and the internet these days, it simply means foreign exchange. So FOR for foreign, EX for exchange, foreign exchange, right? So different people trade different things. Some trade indices, futures, stocks. We hear stocks, that's equity, stocks of like companies like Apple, Tesla, so bonds, currency, and that's forex. So when you hear forex, that means people that trade currencies, that exchange one currency for another, right? So that's my sole purpose in this course, right, in this teaching, to teach you and make you understand the concept of forex trading. So forex is the largest financial market in the world. The forex market has a 6.6 trillion day trade volume, right? So that's the volume of money that is being traded in the forex market daily, like the amount of money that goes in and out of the forex market. So that's huge, right? But let's keep going. Don't get too caught up on that. So the forex market is a global decentralized market where the world's currencies exchange hands. When we say decentralized, we mean there's no one party controlling the forex market. It's not like a company or like a situation whereby we say this bank controls what we do. No, it's decentralized. There's no one power that controls forex market. Like, there are many different bodies, right? And it's global. So our exchange rates change by the second. So the market is constantly in flux. What we mean by this is, typically you'd expect, okay, if I buy, let's say, if you're a Nigerian and you use your naira to buy dollars today, and let's say the exchange rate was 500. So typically you'd expect till it rise to something like 750 before you can be able to sell all those dollars of yours to make profit on it, right? But in the forex market, right, these exchange rates, they change by the second. Like, that's why you see the charts, it will be up, down, up, down, up, down, right? So the exchange rates change by the second, so the market is constantly in flux. So that's how we make money. So the forex market is open 24 hours a day and 5 days a week, right? It only closes during the weekend. So going further, how does forex trading work? So essentially, we are making profits from the exchange rate of a currency against another. So let's take an example, right? Let's assume you speculate that United States dollar will keep rising higher as opposed to Nigerian naira because their economy is better and we have a very bad economy with high inflation, etc. Right? So you basically want to buy United States dollar, you want to convert or you want to buy a certain amount of dollars, right? So that you will have dollar because you have speculated that in the near future United States dollar is going to rise even more higher than the present rate, right? And so you know that when you come and exchange it back by then, you will exchange it into more naira. I don't know if you get this concept, right? So just sit on it, it will make sense, right? So let's say you buy 100 United States dollar, right, with your naira at the exchange rate of $1 is equals to 500 naira. So you have to exchange 500 naira of yours to get just $1, right? So in order to buy 100 of that United States dollar, basically what you're doing is that you are spending 500 times what? Times 100. So let me get this. So you're going to have to spend 500 times what? 100, because you want to buy $100 at the rate of 500 naira to 1. So that means you're going to spend just 50,000 naira to get 100. 50,000 naira to get $100, right? So, and then it turns out you were right, and because of Nigeria's bad economy compared to US economy, the amount of naira you need to get $1, right, rises, right? So that's a change in the exchange rate, because that's basically what we're doing. We're trading changes in the exchange rate. And now let's say you need 800 naira to get 1 USD. Now keep in mind, earlier on you needed 500 naira to buy 1 USD, and now 800 naira to get 1 USD. So that's like a change. The exchange rate has changed by 300 naira, right? So you decide to sell that your United States dollar back into naira, right, to make a profit. And so this time around, 100 USD times 800, because now you're converting back to naira, right? And then you make 80,000 naira. So remember, you spent 50,000 initially and you got back 80,000, right? So that's a profit of 30,000, because 80,000 minus 50,000, that's 30,000 profit made from a change in the exchange rate of those two currencies. I know it's beginning to make sense now, right? So let's keep going. So what do we trade? Now, from the previous example, already established that we trade currencies, right? And we've already also established that in order to trade currencies, you're buying one currency and selling another currency, right? So these currencies are paired against each other in something known as currency pairs, right? Now, these currency symbols have 3 letters. The first 2 letters identify the name of the country, while the third letter identifies the name of the country's currency, usually the first letter of the currency's name. So for example, NZD. When you see NZD, NZ stands for New Zealand, while D stands for dollar, right? When you see NGN, NG stands for Nigeria, while M stands for naira, right? When you see USD, US stands for United States, D stands for what? Dollar. So I know this concept has begun to make sense. That's why earlier on in the previous example we said USD, we said NGN. So this is what we call currency symbols. This is how they are usually written. So when you see this on your platform, which I'm going to be talking about later, don't get confused. That's basically what it means. So the first 2 letters stand for the name of the country, while the last letter stands for the country's currency, typically the first letter, right? So now let's dive deeper into currency pairs. We've established that there are currency symbols, and these currency symbols are paired against each other in what we know as currency pairs, right? So Forex trading is the simultaneous buying of one currency and selling of another, as we saw in the previous example, right? When we sold naira and we were buying dollar, and then when we exchange it back later. So it's the simultaneous buying of one currency. In order to buy a particular currency, you have to sell another. Earlier on, we sold naira to buy USD, and when we're exchanging it back, we sold USD to buy naira. Does that make sense? Yes. So that's what currency pairs are. So currencies are quoted in relation to another currency. That's what we mean by currency pairs. So now we have 3 categories of currency pairs. We have the major, we have the crosses, and we have the exotics. So what do we mean by this. So let's start first with the major. So the major pair, right, they are called major currencies because they're the most heavily traded currencies and represent some of the world's largest economies. So these pairs are typically the one that a lot of people trade more, right? And they represent the bigger countries of the world. So they typically always include the United States dollar. United States dollar is king, right? So any pair that has USD, 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 USD is a major currency pair, right? So they always include the United States dollar, and we have about 7. 1, 2, 3, 4, 5, 6, 7. So we have 7 major currency pairs. Now these pairs all contain the United States dollar as we've established on one side and are the most frequently traded. Compared to the crosses and exotics, the price moves more frequently with the measures, which provide more trading opportunities. Earlier we established that we make money from changes in exchange rates. So basically we want exchange rate to be changing more, right? So this one, the price, that's the major currency pairs, the price moves more frequently with the measures, right? So that goes to say that yes, of course, it does provide more trading opportunities in contrast to those that don't move more frequently as frequently as this, right? So the measures are the most liquid in the world. Now, just like I said earlier on, let's just take a quick side note. What is this liquidity? Because here we just said the measures are the most liquid in the world. So liquidity, what's liquidity? So liquidity is used to describe the level of activity in the financial markets, right? So in Forex, it's based on the number of active traders buying and selling a specific currency pair and the volume being traded, right? So the more frequently traded something is, the higher its liquidity. And we just finished establishing that the major currency pairs are the most traded, right? So they are more frequently traded, so they have higher liquidity. So there's higher number of buying and selling going in, right? So there's a higher number of buying and selling that's going in. That's why we said that they are the most liquid in the world. I hope that concept makes sense. So let's go further. Okay, say for example, more people trade Euro USD currency pair and at higher volumes than the AUD USD currency pair. That means Euro USD is the most liquid, right? Not most liquid, but it's more liquid than AUD USD. That's if more people trade Euro USD than AUD USD. That means Euro USD is more liquid than AUD USD because there's a higher number of selling and buying going in Euro USD as compared or in contrast to AUD USD. So let's go for that. Now, cross currency pairs. So that's the second type of currency pairs. So when we say cross currency pairs, we mean any that include major currencies except the United States dollar, right? So these are known as cross currency pairs or simply the crosses. So in major currency pairs, we established that it must be paired against the United States dollar, right? But in cross currency pairs, it is not paired against the United States dollar, but it's the major currencies. So those major currencies, if you carry them together, right? So let's go over here. So Euro USD, imagine USD is not here, but you pair, let's say, Euro against GPP, that's a cross currency. You pair GPP against JPY, that's a cross currency. You pair CHF against GPY, that's a cross currency. You pair CHF against CAD, that's a cross currency pair, right? So while not as frequently traded as the majors, the crosses are still pretty liquid and still provide plenty of trading opportunities. So these are example of the crosses as we established when we went to the previous slide: Euro GBP, GBP JPY, GBP CHF, GBP AUD, Euro. So you just have to know what these names all mean, right? You can go to platforms such as TradingView to go understand what they mean. So GBP Great British Pound, JPY Japanese Yen, CHF Swiss franc, AUD Australian dollar, right? CAD Canadian dollar. So that's what all this means. So those are cross currency pairs. I'm sure it's all making sense now. Let's go further. Now, exotic currency pairs is the third category of currency pairs. So when we say exotic currency pairs, we mean they consist of one major currency and one currency from an emerging market, right? So this is what we mean when you pair United States dollar against the currency of a country that is not really that traded. Even if you pair USD against Nigerian dollars, it's an exotic currency pairs because it's not liquid, it's not highly liquid. There's not a large number of people buying and selling in those markets. So that's what we mean by emerging market. United States dollar against Singapore dollar, against Danish krone, against Swedish krona, against South African rand, right? So all these are currencies from emerging markets. They are not really that traded, right? So they are not that liquid. We're going to go into how to read the forex codes. So we've already established what currency pairs are, but and we say they are quoted against each other, right? So how do you read that? Like, how does that come and make sense in a practical situation? So currencies are always quoted in pairs, such as GBP, USD, or USD, JPY. The reason they are quoted in pairs is that in every foreign exchange transaction, like we established earlier, you are simultaneously buying one currency and selling another. So how do you know which currency you are buying and which you are selling? This is where the concept of base and quote currency come in. Let's take an example. On your platform such as MetaTrader is the platform where you establish or where you make executions. Let's say you want to buy or sell, you do it on MetaTrader, right? So let's say you see something like this: GBP USD equals 1.21228. How does it make sense? How do you know what 1.21228 means? Like, okay, we have established that we make money from differences in exchange rate, so you might already know it's an exchange rate. But what currency is exchange rate, right? Okay, so let me introduce the concept of base and quote currency, right? So the first listed currency to the left of the slash, sometimes you see this slash, sometimes you wouldn't, sometimes you just see GBP USD. So the first currency, right, is known as the base currency. So in this example is the British pound, that's GBP. Now it's the reference element for the exchange rate of the currency pair. It always has a value of 1. Now this is not the 1 here, it just always has a value of what? 1. Coming to that. Alright, while the second listed currency on the right is called the quote currency, right? It's called the what? Quote currency. Okay, so let's go further on this. Now when buying, the exchange rate tells you how much you have to pay in units of the quote currency. Now the quote currency is the second currency, so how much you have to pay in units of the quote currency, that's the second currency, to buy 1 unit of the base currency, which is the first currency. So let's just bring this back. When buying, the exchange rate tells you how much you have to pay in units of this, how many USD you have to pay, right, to buy 1 unit of this. That is what this exchange rate tells you. So you need to spend $1.21228 to buy €1. That makes sense, right? Okay, so in the example above, you have to pay 1.21228 United States dollar to buy one. Okay, sorry, this is euro, right? To buy €1, right? So when selling, the exchange rate tells you how many units of the quote currency, when selling, how many units of this you get for selling 1 unit of this. Let's sit with this, or let's go back. Okay, when buying, the exchange rate, this exchange rate tells you how much you have to pay, how many United States dollar you have to pay, because we have established base currency is always 1. So it tells you how much you have to pay in units of this to get this, how many United States dollar you have to pay to get €1, because now you want to buy euro. When you want to sell, it tells you how many United States dollar you are going to get for €1. So this is always 1, and that is this figure here. So this is always 1. Now this makes sense, right? So when selling, the exchange rate tells you how many units of the quote currency you get for selling 1 unit of the base currency. So base comes first, quote comes second. Even in the alphabetical table, B comes before Q. So just keep that in mind. Whenever you see British pound, I mean euro. I don't want to stop the presentation. So in the example above, you will receive 1.21228 United States dollar when you sell what? 1 British pound or €1. If you buy euro USD, this simply means that you are buying the base currency and simultaneously selling the code currency. Why is that? Because you are selling what? 1.21228 of your United States dollar to buy €1. That's what it means by you are buying the base currency and simultaneously selling the code currency. You will buy the pair if you believe the base currency will appreciate or gain value relative to the code currency, right? Because now what you're doing is that you are buying euro. That means you're going to keep your money in euro because you have a feeling that this exchange rate is going to go higher one day, and when you come to sell it, you get more of what? The currency that you're going to buy back into. Makes sense, right? Because now the exchange rate is 1.21228, right? And you have a feeling that one day is going to be 1.22 something something. So you know that if you buy euro today, right, and you wait for that day to come and you sell, you are going to get more of the United States dollar, right? All right. So just like earlier on we had USD here. Let me use this pen. Earlier on we had USD here, right? And we had NGN here, right? So in this kind of scenario, what that means is, because you see something like USD NGN equals to 5, let's say 500, right? So when you see this, what does that mean? So this means that you have to pay 500 of the code currency to buy 1 USD. Remember, this is always 1. So let me not confuse you when you come and say USD here. The base currency is always 1. And then when you want to buy Naira, right, that means 1 USD, right, will give you what? 500 of the code currency. So let's say you have a feeling that one day this exchange rate is going to be 1,000, right? So you buy USD at 500. Making sense? You buy USD, 1 USD at the rate of 500, and so one day it now turns out to be 1,000. Now that 1 USD that you bought now is equals to what? 1,000. Now that 1 USD that you bought, now when you are converting it back, you are going to sell the USD to buy Naira at the rate of what? 1,000. So you spend 500 to get $1, and then now, because this still has a value of 1, that your $1, converting it back to what? Naira, you are getting what? 1,000 Naira. So let's keep going. Why you would sell the pair if you think the base currency will depreciate relative to the code currency. So what that means is, imagine, let's say you have a feeling that one day this is going to be, the exchange rate is going to be, let's say 1.2000, right? That means the exchange rate is going to go lower. What you want to do is that you want to sell them. That means this your euro, you are going to convert it back to dollar and hold it in dollar so that you can come and change it back later, because you have a feeling that this is going to drop. Because I think this is a concept that confuses people in trading, the idea of selling something you don't have, right? So let me explain it in this way. Earlier on we said that if the exchange rate is going to rise, right, you want to be buying this, right, to keep it and wait. Now because you're already having that money there in your broker, I'll explain broker later, right? Now you have a feeling, or you've speculated, that this exchange rate, this right here, is going to drop, right? So that's where the concept of selling comes in. Don't let it confuse you, right? The concept of selling now comes in because now, okay, you're speculated that this exchange rate is going to drop, which means the amount of dollar that you will have gotten back for this is going to what? It's going to drop. So what you're going to do is that you're going to sell euro, right? And then by selling it, you're actually making money. Does that make sense? Okay, let's keep going. Some of these things will make more sense as we keep going further. So let me clear this ink and let's keep going. Now let's take a quick note. Whenever there are some terms you'll be hearing like long and short. So whenever you hear long, right? So if you want to buy in trader talk, this is called going long. So sometimes you hear people saying I'm longing GBP USD. That means I'm buying GBP USD, right? So just remember long equals buy. And then sometimes you hear people saying going short. So if you want to sell, this is called going short or taking a short position. So just remember short equals sell, long equals buy. Going further, we are going to be introducing the concept of bid, ask, and spread. So let's use the previous example of Euro USD base quote. So what is bid? Now the bid is the best available price at which you, the trader, can sell to the market, right? So if you want to sell, your broker will offer you the bid price. So this is typically the bid price, right? The bid price usually is going to be lower than the market price, because what we have here is the market price, the present exchange rate. But the broker, let me explain what broker is. Broker is where you basically put your money in. Let's say you have $100 and that's what you want to trade, that's where you're going to put it. But when you want to, let's say sell, and this is the present exchange rate, your broker will give you a different price at which you can sell, right? I'll explain why it's very soon. So this is the bid and that's the selling price. What is ask? The ask price is the best available price at which you can buy from the market. So remember, we say when you want to sell, you get bid and it's typically lower than the present market price, and then when you want to buy, right, you get the ask price and it's typically higher than the present market price. So now let me explain something. Assuming you have an iPhone and the present market value of that iPhone is like, let's say 500,000. When you go to Aboki to go and sell, let me not say when you go to go and sell the iPhone, right, he will say, okay, I'm going to buy this iPhone from you at a lower price. He won't tell you that, but he's going to tell you, I'll buy this iPhone from you for like, let's say 450,000, despite the fact that the price in the market is 500,000. Why is he doing that? Because now he has to make sure that when he comes to sell it, he can make profits, because the present market price is what? 500,000. If he buys it from you at 500,000, what's he making? Nothing. So that's what this means. That's why you brokers do this, right? Because that's where they make their money, from the changes in this, right? Because you see here, the difference here is 1 is here, 2 is here, 3 is here. So they are going to sell to you at this price because they are making money from the difference here. They are going to they are going to let you buy at this price because the difference between market price and this one here is where they are making their money. So that is what we call spread. So the difference between the bid and the ask price is known as the spread. So in this case, the difference between this bid and the ask price is 0.002, right? So I'll explain. You're probably wondering, okay, how do I calculate this point, blah blah blah, point blah blah blah. That is what I'm going to explain very soon. But before then, let me explain something called lots. What are lots? Let's take another analogy. When you go to the grocery store and you want to buy an egg, you can't just buy a single egg, right? In the grocery store, they will tell you, okay, you cannot buy this single egg. Like they come in dozen or lots of 12, right? So imagine you can't buy a single egg. You have to buy the entire crate, as we call it here. And in a crate, let's say it's 12 or 24. So that's what we mean by lots, right? So in Forex, it will be just as foolish to buy or sell €1. So they usually come in lots, because what you have to understand is that this change in exchange rate that used to happen on the charts, they don't happen like, let's say, a change in €1 or a change in €2. So if you are just buying or selling €1, you are not going to make money, right? Which means you are buying and selling a large quantity of euro actually, to actually make money from the minute changes in exchange rates, right? So that's what lots are. So instead of buying like 1 egg or €1 in the case of forex trading, you are buying in lots, in quantities, in certain quantities. So now when you're buying 1,000 units of the currency, that's like you're buying 1,000 euro. It's called a micro lot. When you're buying 10,000 units of the currency of like euro, it's called a mini lot. When you're buying 100,000 units, it's called a standard lot. I know you're probably wondering, well, I don't have $1,000, or I don't have 1,000 euro. I don't have the money to buy 1,000 euro. I know. I'm coming to explain that, right? So it all depends on the broker you use and the type of account that you use. Sometimes you even see nano lot, which allows you to buy 100 units, right? But I don't have enough money to buy 10,000 euros. Can I still trade? That's where leverage comes in. So that's the next concept we are going to be introducing: leverage. Trading with leverage. So when you trade with leverage, you wouldn't need to pay that 10,000 euros to buy that that mini lot, right? So instead, you'd put down a small deposit known as margin. So that's what margin trading means. When you hear margin trading, that means you're trading with leverage, right? So leverage is the ratio of transaction size to the actual cash you used for margin. Yeah, I know all this is sounding like big English right now. Let me just break it down. For example, a 50-to-1 leverage, also known as 2% margin requirement, means that, let's say you want to open a position or you want to buy 100,000, that's a standard lot of a particular currency, and you don't have up to $100,000, right? You would deposit $2,000 and use a leverage of 50-to-1. Now this 1 stands for however much capital you have. So in this case, your 1 is $2,000, and when you times $2,000 by 50, you have 100,000, which means now you can open a position size worth $100,000, which means you can open a standard lot. I know the concept is making more sense now. So as we go further, it will make even more sense. So margin trading lets you open large position sizes with only a fraction of the capital you'd normally need. Because in this case, you would have needed $100,000 to open a standard lot, but because of leverage, right, a leverage of 50-to-1 allowed you to open a $100,000 position with just $2,000 of your capital. Now some of you are out there and be like, hey, I still don't have $2,000. It does not matter. Like, this is just an example. Even if you had, let's say, $100, right? If you had $100, if you do $100 times 50, right, that's like $5,000, right? So let's bring up the calculator. 100 times 50, right? Sorry, 100 times 50. That's what? Like we said, $5,000, which means now you can open $5,000 position with just what? 100. With the leverage of what? 50-to-1. Now keep in mind that 50-to-1 is not the only leverage. You can have 100-to-1, which means with even lesser capital you can open bigger position. We have, what was it, 500-to-1, right? And so on and so forth. Just keep in mind that despite the fact that you can be able to make more money with little capital, you can also lose more money because of your leverage, right? So let's just go by this. So that's how you're able to open $1,000 position with as little as $100, right? Because in the example we just gave, a $100 with a leverage of 50-to-1, you can open $5,000 position with that, right? So that means you can open 5 micro lots with that, right? Because one micro lot is what? $1,000, right? So that's how you're able to make large amounts from little movements in price in a short time. It also means you can lose a lot of money in a short time. So this concept will make more sense as we're going further. Typically, I've come to realize that in learning, some of these concepts won't make sense when you're just looking at it abstractly, but when we get into it practically, it will make more sense, right? So it also means you can lose a lot in a short time. We have different types of leverage, right? So just like I explained here, we have 50 to 1, 100 to 1, 500 to 1. I will leave a link in the description, right, for those of you that are just starting, to go and try opening a demo account with a broker, so that you will see how there are multiple types of leverage. But first, let's keep going. So how do we calculate these movements in Forex? Okay, how do I know that in between this exchange rate and this exchange rate, this is the amount of money I'll make, right? So that's the concept we are going into next. That's a pip. So what is a pip, right? Here's where we're going to do a little maths, just a little bit. Take your time with this information, as it is required knowledge for all Forex traders. The unit of measurement to express the change in value between two currencies is called a pip. Let me go over this again. The unit of measurement to express the change in value between two currencies is called a pip. So every single thing, that's why you'll be hearing people saying, I made 50 pips today, made 100 pips today, because that's the unit of measurement between the change in value of those two currencies. Because we are Forex traders, we have already established that we are making money from exchange rates, from those change in exchange rates, right? So pip is the unit of measurement for that. So a pip is usually the last decimal place of a price quote, right? Most pairs go up to 4 decimal place, but there are some exceptions, like Japanese yen pairs, right? They go to 2 decimal places, but pip is usually the last decimal place. If you happen to see a case whereby there are 5 decimal places, then you just count the 4th decimal place. So in this case, if Euro USD moves from 1.1050 to 1.1051, right, that means the change is what? 0.001. Remember, the last decimal place, it was 0 here, now it's 1, right? That's a rise in value of what? 1 pip. It was at 50, now it's at 51. It increased by what? 1 pip. Why is that? Because in case you're not a math whiz or anything like that, I'm not either, but these are first decimal place, second decimal place, third decimal place, and fourth decimal place. And we've already established that our pip is the what? The 4th decimal place. So if there happens to be a case whereby you see 5 decimal places, that doesn't matter. You should still count your 4th decimal place as your pip. That's an example like Euro USD. If you're trading something like USD JPY, it's typically going to be 2 decimal places, right? So you see something like, now this is your pip, right? If it was USD JPY. So going further, in some cases, like I said before, you will see price quotes written in 5 decimal places. In such cases, you will simply count the 4th decimal place, and that's your pip value. So the 5th decimal place is known as a pipette. It's what? 1/10 of a pip. So let me just give an example. With the example of area 1.050, okay, 1.1050, these are pip, right? These are pip, right? And let's see, there was now 1 here. This is known as pipette. Is what? 1/10 of a pip. But remember, our unit of measurement is still the pip. So now, why do we say it's what? 1/10 of a pip? Because this will have to change 10 times before. Okay, let's see. Before this 1.050 becomes 1.051, that's a change in 1 pip value, right? There will have to be change in 10 pipettes, because it will have to go from 1 to 2 to 3 to 4 to 5 to 6 to 7 to 8 to 9 to 10. Before this, it's when it becomes 10 that then 1 will now change here. So a pipette is what? 1/10 of a pip. That's just something you should just keep at the back of your mind. So let's go over this again. A pip is the unit of measurement to express the change in value between two currencies, right? It's typically the 4th decimal place, or the second decimal places, second decimal place in currency pairs such as USD JPY. So 4th decimal place or second decimal place. So let me show you an example that I worked up. We've already established bid quotes, base quotes, ask, bid, right, and spread. So I just want everything to appear on the screen now so that you can be able to see. So we've already established what a base currency is, quote currency, what bid and ask is, what spread is, right? So spread is the difference between bid and ask, right? And that's how your brokers make money off you. It's a good thing actually. We have fixed spread, we have variable spread. All of that you'll see as you progress further in your trading career. So how do you know when it's something like 100 pips, right? So first decimal place, second decimal place, third decimal place, fourth decimal place. So if you have 8 here, is what? 8 pips, right? But if you have 3 in front of this, that means you have 38 pips, right? If you have 5 in front of this 3, is what? 538 pips. Let me give another example. Assuming you had 1.11000. Now this is our pip value, right? So will you say our pip value is 0? No. So if you go further, still 0. If you go further, then you finally have 1, right? So let's say you're expecting that price will go from 1.1000, right? And this is our pip value here because it's a 4th decimal place. You're assuming the price will go from 1.1000 to 1.1100. That's a change in what? 100 pips, right? Because this is our pip, right? And then as you're going further, this one is what you're expecting to change to 1. So that's what? 100 pips. So you're expecting the price to make a 100 pip change. I'm sure this concept makes sense to you. So 8 pips, 38 pips, 538 pips, 1538 pips. So let's keep going further. Earlier on we started talking about lots and how we gave the analogy of if you are to go to a grocery store and buy egg, and you can't just buy one egg, you have to buy a dozen. So that's what lot is, right? We established that we have standard lot, we have mini lot, we have micro lot, right? And a standard lot, we said, is 100,000 units of the currency. We said that a mini lot is 10,000 units of the currency, and we said a micro lot is 1,000 units of the currency. So going further, Forex is commonly traded in specific amounts called lots, or basically the number of currency units you will buy or sell. A lot is a unit measuring a transaction amount, right? When you place orders on your trading platform, orders are placed in sizes quoted in lots. Because when you want to open a position, let's say you have speculated that, okay, just like in the previous example, you expect that there's going to be a 100 pip change in a particular exchange rate, right? So how do you now buy or sell that currency? It's quoted in what? It's quoted in lots. So as you may already know, the change in the currency value relative to another is measured in pips, which is a very, very small percentage of a unit or currency value. Because that pip, let me go back there. This is actually, let's say this is like €1, and this is what's changing, like the 4th decimal place. If you're buying just €1, how will you make change of, let's say, 100 pip change? You won't make any substantial profit, right? That's why I said you cannot just buy €1 or $1. You have to buy in lots, right? So to take advantage of this minute change in value, you need to trade large amounts of a particular currency in order to see any significant profit or loss. Let's assume, right, we'll be using 100,000 units. That's a standard lot. We'll now recalculate some examples to see how it affects the pip value. So we already know standard lot equals 100,000 units of the currency, mini lot equals 10,000 units of the currency, micro lot equals 1,000 units of the currency. So now, what's the difference in pip value between this and this? What's it? So just pause for a second, and let's see if you can tell me what. It's 1 pip, because here this is the first decimal place, second decimal place, third decimal place, fourth decimal place. Everything else is the same except this. So there's a change in what? 1 pip, right? What's the change in pip value between here and here, or the difference in pip value? It's also 1 pip, because here is 2, here is 3. 3 minus 2 is 1. 1 pip value. 2 minus 1 is what? 1, right? So let's say you open a position, right, with a standard lot, right? That's $100,000 at this point, at this rate. Now forget that this is bid and ask or anything. Now I'm just saying if the price went up from 2 to 3 and you open $100,000 here, how do you know how much you've made in between here and here? That's where we're going to next. So for a standard lot, that's 100,000 units of the currency. What you're going to be putting on your broker platform is 1.00. Now don't let this confuse you, right? So for a standard lot, if you want to open 100,000 units of this currency, right, you want to buy or you want to sell, what you're going to be typing down on your broker platform is 1.00. If you want to execute, open a position worth 10,000 units, right, what you're putting down on your platform is 0.10. If you want to use micro lots, which is 1,000 units of the currency, what you're writing down on your platform is 0.01. Now some platforms don't offer these nano lots, so we're just going to skip this for now. But in case you do come and see something like this, then for a nano lot, which means you're buying 100 or selling 100 units of the currency, you're opening 0.001. So just get this stuck in your head, perhaps screenshot it or something. So standard lot, 100,000 units of the currency, is 1.00. Mini lot, 0.10, 0.01. So in the same vein, let's say you want to open 500,000 units. That's what? 5.00. If you want to open 50,000, that's what? 0.50. If you want to open 5,000, that's what? 0.05. If you want to open 6,000, that's what? 0.06. If you want to open 7,000, that's what? 0.07. Here, if you want to open 17, if you want to open, let's say, 17,000, right? That's what? 0.17. Because 1 starts for what? The 10,000 here, and then the remaining 7 is what? Micro. So it now come here 7. 0.17. That's 17,000. Let's say you want to open 110,000, right? 1.10. 150,000, 1.50, because 50,000 is going to be what? 0.50. If you add that to 1 of this 100,000, that's what? 1.50. So for more explanations on all these things, you can go to babypips.com. Let me write it down here. babypips.com. So they have understandable articles on all of these things. So if there's any concept you don't understand real well, just go to babypips.com, and this is babypips.com. babypips.com. All right. So when you open a position with 100,000 units, right, that's a standard lot, per pip you are making $10. In an example like Euro USD, I trade Euro USD, so I'm going to use that as an example. So if you open a standard lot, you are making $10 per pip, which means in this previous example, if you had opened a standard lot here, right, and then it goes from here, from 2 to 3, you have made $10. From 2 to 3. I know somebody is really excited right now. It's like, what? With that little movement, with that little movement. Keep in mind, standard lot is a pretty big lot. If you are over leveraging on your account to use a standard lot, which means if it also goes from 2 to 1, let's say you have a $100 account and you now use a very high leverage that allows you to use a standard lot over here, right? Imagine it doesn't go from 2 to 3, but it goes from 2 to 1. It goes from 2 to 1. You have lost $10. Imagine now goes downwards again. You have lost $20. Goes down by another pip. You have lost what, $30. And that's how you can easily blow your account, because you over leveraged so that you can use a higher lot size. Right? So you want to use a leverage. Right? You want to use a leverage that will allow you to use lot sizes that are within the comfort of your account. Something that will not just blow your account if there's a change in pip value. So while if you're using a mini lot, that's 10,000 units of the currency, that's 0.10, right? Per pip is a change in $1. So now let's go back to this example. So if you use that mini lot and there's a change from 2 to 3, what have you made? $1. So now if you're using a $100 account, that means in order to blow that $100, you need a change in what? In order for you to lose the entire $100, you need 100 pip to go against you. You see, now that's comfortable. You are not trying to use a huge lot that's beyond your account. You are using a lot size that is within the comfort of your account, right? So while for a micro lot, that's 1,000 units of the currency, per pip you are making $0.1, which means in order to make $1, there has to be a change in 10 pips. There has to be a change, right, of 10 pips to make what? $1. To make $2, a change in what? 20 pips. While in this case, in order to make that $2, you just need 2 pip change. Here, in order to make $20, you just need 2 pip change, right? While for these nano lots, as you can see, in order to make 0.1, he needs 10 pips to go in your favor. So it's all about your account size and how you leverage your account. Just keep this in mind. We are going to be going over those concepts when we come to risk management and technical analysis, but I just wanted to tell you this right now. So some of these things you can go read more articles on them, because this is meant to introduce you into the concepts so that you get what it means fundamentally, right? And then go introduce yourself into more and more of the concept. Okay, so this is what it would look like on your trading platform such as MetaTrader, right? Remember earlier on I said 1 here indicates what? Standard lot, and that means you're making $10 per what? Pip. And if there was 5 here, what are you making? You're making $50 per pip, right? If there was 9 here, you're making what? $90 per pip. Which means if there's 1 here, you're making what? $100 per pip. Which means now that there's 5 here, you're making $500 per pip. So these for people that have either the capital or over leveraging. And then this is our bid. What's our bid price? Our selling price, right? What's our ask price? Our buying price. So the platforms you can go check out. You don't have to download both. You can download either. That's either MetaTrader 4 or MetaTrader 5, right? MetaTrader 5 is the latest version, but depending on your kind of broker, some brokers will ask you to choose either MetaTrader 4 or MetaTrader 5. So both of them are pretty good, right? Some people prefer 4, some people prefer 5. I guess it all comes down to your preference, but both of them, they are for execution. They are, if you open a platform with an account with a broker, they will give you your login and your password and tell you either for MetaTrader 4 or MetaTrader 5. So while TradingView, when we begin technical analysis, TradingView is the platform we're going to be using. So TradingView, we use it for analysis. MetaTrader, we use it to execute ideas, right? So let's say you've already speculated that okay, there's going to be a 100 pip value change in this particular currency pair. You now come to your MetaTrader, you now put your lot size, you choose where you want to buy or where you want to sell. So we'll be going further into and diving deeper into some of these concepts in the next video. For now, goodbye.